Hello, welcome to Chapter 17, Pro-Forma Financial Projections. Without any further ado, I'm going to jump right in. All right, so first question that might be burning on you right now is, what are pro forma projections? Well, pro forma projections are simply financial statements that we project forward into future accounting periods. So next thing that might be on your mind is, who cares? Why do we want to project financial statements into future periods? Well, it turns out there are three pretty compelling needs for this. The first one is to estimate ratio analysis into the future. So as we saw in Chapter 6, ratio analysis can be a really good tool, but we were kind of limited in our use of that tool because everything that we were looking at was historical. All the financial statements we used to build ratio analyses were historical statements. So we can help overcome this by creating projections of future financial statements and then performing ratio analysis on those. And that can give us a much brighter picture of what might be happening to a given entity going forward. So the second need for proformas is valuing entities using our DCF methods, right? And recall, for our simple accounting cases, valuing an entity, when we valued for shareholders, we needed, in a general case, we needed all sorts of information from financial statements from future years. And the same thing was true when we were trying to value an entity for the whole debt and equity team. The only way we could really estimate future cash flows of an entity was to project forward the financial statements and derive our estimate of free cash flows from those. And then our third need for proformas comes up very often in the real world inside an entity, is to help answer big questions for the CFO or the CEO or the board. So, for example, we could say, if we institute a dividend of 15% of net income next year, what will that do to our cash level at the end of the year? Pro forma projections help us answer that type of question better than really any other method. Another example would be, what if we hold our debt level constant for the next 3 years? How will this affect our capitalization as measured by debt divided by enterprise value? So what's our framework for creating pro formas going to be? Well, as usual, we're going to start at t=0. And as usual, assets at time t=0 are going to be equal to liabilities plus equity, right? In accounting, that fundamental accounting equation is true at all times under all circumstances. And for a future period, t=1, say 1 year from now, we're going to use reasonable methods to estimate the value of each asset, liability, and equity account such that at t=1 year from now, the assets at that time will equal liabilities plus equity at that time. So we'll still be satisfying in the future our fundamental accounting equation. So what are these beautiful, reasonable methods anyway that we're going to use to estimate the values of accounts in period 1 in the future? Well, there are several. The first one is, we're going to assume that the future will be similar to the past. We don't mean by that a company is not growing. What we do mean in this case is that there are no major industry or economic disruptions going on. And that's typically been our base case throughout this semester. Next up, we're going to compute an individual account's future value in one of these three ways in order of preference. This is important. This is something that should maybe make it to your helper sheet for exam 3. So first thing is, we're going to ask the question, has the CFO or the board of directors given us a directive for this account value in a year? For example, the board could say, we want you to hold the debt level constant for the next 2 years. And If there's no directive from the board, that's thing number one. So we check for that first. And if the board tells us what to do or the CFO tells us what to do, that's just how we project it. Okay. And next up, if we don't have a directive, then we'll use an accounting equation. One of our accounting equations, of course, is assets equal liabilities plus equity. But as you're going to see, there are going to be several accounting equations we can use to help us out. Here's another example. Interest expense is equal to debt at the beginning of the period times interest rate. We've used that all semester. That's always true. So when we have an always true equation like that, we'll go ahead and use it. And then if we don't have a directive from the board, that's number one. And number two, we don't have an accounting equation we can use, then we're going to use what's called the constant percent of sales assumption. And in this case, we'll say that an account's value in the coming year, year one, is going to be equal to the sales in year one times the account value at year zero, t equals 0, divided by the sales at year 0. So in other words, the ratio of the account value in year one to sales in year one is going to be equal to what the ratio of the account value right now is to sales in the 12 trailing months. So we just keep that ratio constant. And of course, by the magic of algebra, we've solved here for the account value in year one. So those are the 3 ways that we're going to project forward accounts specifically. And there is actually a very good rationale for our constant percent of sales assumption. This works actually very well in the real world, and you can see this with analysis of historical financial statements, et cetera, et cetera. But here's an example showing how it works and why it works. Let's say our accounts receivable has been running at 10% of sales for the past 3 years, and there are no big changes to our firm's structure. There's no disruption in the industry. Well, if accounts receivable has been running at about 12% of sales for the past 3 years, it's safe to assume, in lieu of a big disruptive force, that that will be true in the next year. And again, empirically, we do find that this assumption works very well in the real world. So that's our third way to project when the first 2 don't apply. Okay, quick note on seasonality. Seasonal companies are going to require at least quarterly projections, possibly monthly projections. And the reason for that, as we saw earlier in chapter 6, is if we plot, for example, the sales of a company over 4 quarters of a year, it might look something like that for a seasonal company, and for a non-seasonal company, it might look something like this. So for a non-seasonal company, everything's fairly linear inside each quarter of the year, so we don't have to look at that. But for the seasonal company, if we just go from the beginning of the year to the end of the year, we've missed all of this important stuff inside the year, and that's going to be very important for the microeconomics of the company. So we'll have to be careful for seasonal companies to project them quarter over quarter or month over month, but for non-seasonal companies, we can project year over year. So remember, we said that how we're going to project is, first, we're going to ask, is there a directive from the board or the CFO? If yes, then that account goes as per the directive. Second, we're going to say, is there an available accounting equation to help us project this account? So here's a list of the accounting equations that we'll use to help us project accounts. And all of these assume our simple entity valuation that we used in our discount and cash flow entity valuation chapters. So the first equation we've got here is what's called a PPE roll forward equation. And this says that PPE net in the beginning of the period, beginning of the year, minus depreciation, minus the amount of PPE that has worn out, plus CapEx, plus additions to PPE equals PPE net at the end of the period, at the end of the year. Makes sense. Okay, we have a similar roll forward equation for equity, which says that equity beginning of period plus net income, that's of course an addition to equity, plus paid in capital, another addition to equity, minus dividends. Dividends are always a subtraction to equity, equal equity end of period. And then we have a few more here. We have our interest equation. Interest expense is always equal to the pre-tax interest rate times our total debt at beginning of period. And our tax expense is equal to our tax rate times our earnings before tax. These are all equations that we've used before. And then finally, let's not forget, last but certainly not least, the fundamental accounting equation, true at all times, under all circumstances, assets equal liabilities plus equity. So now we're ready to talk about specifically creating pro forma projections, how we're going to do it with a high level of specificity. All right, so the first thing we're going to need are directives from the CFO or the board on certain accounts. We're going to need a historical balance sheet, income statement, PPE roll forward equation, and an equity roll forward equation. And we're going to have to remember the accounting equations that we just looked at on the last page. And then finally, we frame this such that there's one unknown big question account on the future balance sheet. And we're going to solve for that. We're going to solve for the value of the big question unknown account on the balance sheet. And how do we get these big question unknown accounts? Well, they come from questions to us from the CFO or from the board, something like this. If we introduce a dividend payout of X, what will our cash balance be at the end of next year? So in that case, we'll be solving for the value of the cash account on the balance sheet at the end of the next year. We could also get a question like this. If we increase CapEx expense by Y%, how much total debt will we have outstanding at the end of next year? Then we'd be solving for the value of the debt account on the balance sheet in the next year. Okay, there's a little note in here in gray. I think I'm going to leave this one gray, even though it's black in your notes, because it's really geared for the finance majors. In general, our big question account doesn't have to be on the balance sheet. It could, of course, be on the cash flow statement or the income statement. But for this class, we're all beginning in Fin 301 to do all of these things. We're gonna restrict our big question accounts to be balance sheet accounts. All right, so what are we going to need to project exactly in future periods? We're going to need our PPE roll forward, and we're going to need our income statement. And this is in the order that we'll want to project them into the next year. So first will be PPE roll forward, second will be income statement, third will be equity roll forward, and then fourth will be balance sheet. And on the balance sheet, when we're projecting, remember, we'll have enough info to project every account on the balance sheet except for the big question account, okay? And let's say we've got our big question account being the cash account. How are we going to solve for that? Well, we'll solve for it like this. Let me just write in a few helpful notes for us. So here's an example showing how we can solve for the big question account when that account is equal to cash. So what are we going to do? We're going to project everything that we know, and that's going to be everything but the cash account. And we're going to remember that assets equal liabilities at all times under all circumstances. So what's another way to say that? Cash plus all other asset accounts equal liabilities plus equity. And then we apply, you guessed it, the awesomeness of algebra to leave cash all by itself on the left-hand side. Cash is equal to liabilities plus equity minus all other assets. And then we go ahead and solve this equation for cash, and that's the value of our cash account. That answers the big question for the big question account. All right, so let's look at an example with Sahali Snacks.